Good day and a warm welcome to today's earnings call of the Iute Group AS, following the publication of the first half-year figures of 2025. I am delighted to welcome the CEO Tamo Sild, CFO Christel Kurwitz, and CRO Tavo Raumegi, who will speak in a moment and guide us through the presentation and the results. After the presentation, we will move on to a Q&A session in which you will be allowed to place your questions directly to the management. We are looking forward to the presentation, and with this, I hand over to you, Tamo.
Thank you, Judith. Thank you very much. Warm welcome and good morning to everybody on the other side of the line. We have today quite big audience. We are happy to have a big audience. We look forward to your questions. So where to start from? I would like to start with a big thank you to our teams in every country, because we have made significant qualitative advancements during the first 6 months of year 2025. What does the quality mean? Quality means that something which we have converted inside into status A to status B, basically we call it improvement, that transformation also starts to transform into the real business numbers, which are visible outside to you, dear investors. So we see that Iute Group's revenue has been growing, and during first 6 months, we made almost 60 million euros from our customers for the services we provide to them. We also have improved significantly our operational efficiency. So the OPEX to revenue ratio, first time in Iute history, is below 37%. And this is thanks to improvements in many places, and not to say the least in Enerbank. We have also increased the revenue of Enerbank together with the revenues actually everywhere, in every value stream. As you know, we are pursuing to become a digital bank with a super app, most used super app in every country where we operate. So we see that the revenues are increasing from customers who use insurance intermediation, also customers who use wallet services, and the biggest part of our bread comes from the lending. So also lending revenues have been increasing. So the only pinch of salt which I would put to this picture is that, or maybe it's a challenge, maybe it's not a salt, it's a challenge. We want to have more customers. We think that our value proposition to our customers is improving, and we actually want to see more customers in the coming quarters. And judging by the July results, I think the customers will follow our increased value proposition. So what else do we see on the big picture? We see that the total customer number stands at 260,000, give or take. And with a revenue of almost 60 million euros, we achieved net profit of 6.7 million euros. Again, I will make a little adjustment here, telling that 6.7 million euros is thanks to our successful litigation against one government in one country, where we got entitlement by the court to get a tax refund in amount of 1.4 million euros. Without this, the net profit will be around 5.4 million euros. The number of active MyIute users, as you see, is somewhat less than the total active customers. If total active customers are the people who use our services and pay for them on an ongoing, stable basis, then you might wonder whether 218,000 active MyIute customers indicates that there are somewhere about 40,000 customers who are not using the app. We are telling the digital story. Where are those customers? Well, they are customers of Enerbank, and we are not listing here the Enerbank app users. Otherwise, the total number of customers who use digital channels, either MyIute super app or the more simpler Enerbank app, this number in total exceeds 260,000. What else to comes down to the qualitative improvements is the customer performance index, CPI, which we see is inching back, climbing up towards 90, slowly. But every single percentage point of CPI is worth approximately 1 million euros net profit annually for every 100 million euros of loan portfolio. And our net loan portfolio as a group stands at 300 million. So the CPI has been improving. As a result, of course, the cost of credit losses is decreasing. And the bottom line is the net profit, which I already commented. We also see that the share of fully automated loans is increasing. Well, automated loans is not something which you can do in blind, but that actually means synchronical cooperation of different business capabilities, starting from data science, which is in turn built on data warehouse, which is in turn built on different digitalized business processes from which we can generate the data, retrieve the data, and process it into a model which gives tangible business results. So automated loans, on the one hand, data science and everything, all the pillars on which it stands, but also it means evolution on our side, the user experience and change of loan approval business processes, so as to enable humans to do what they do best, which is to interact with customers, but let the machine take the decision based on hard data points as to whether we are willing and at what price, at what individual price per customer, we are willing to take the credit risk. So the share of automated loans increased to almost every third loan being fully automated. By end of the year, we expect to see at least half of the loans fully automated. I actually could even say that as of this morning, we have already one country in the group where the share of automated loans exceeds 50%. And we are very happy about it because it has very good impact on our OPEX to revenue ratio.
You want to keep it as a secret? Which country?
The country. Oh, let's keep it for a time. Yeah, let the country also push further, and we will mention it next time because with the lead that they have, I think they certainly deserve praise after Q3 when we see the group automated loan share increasing. And this is in the big picture: quality transforming into quantity, quality transforming in internal quality, transforming into profitability, into increased revenues, and we expect the quality to transform into the increased number of customers. Now, if we focus our minds only to the loan portfolio of Iute Group, and we see that the gross loan portfolio on the left side of the slide, the gross loan portfolio comparing 2023 to 2024, you see a growth from 250 to 317 million euros. But if we more interestingly compare the 6 months 24 to 6 months 25, we see again a climb, and we see climb on both bank and non-bank side. I cannot wait for the time when we stop talking about bank and non-bank. Maybe this time will also eventually come. It will come. But for time being, for increased transparency, we continue talking about bank and non-bank business, even though we are on one Iute Group. So we see growth in the portfolio. We also see growth in the loan issuance, even though the loan maturities are slightly growing larger. Our exposure per customer, per good customer, is increasing. Loan amount per customer is increasing. We also see that the issuance is increasing. So quarter on quarter, first time in our history, we exceeded 100 million euro mark, and we made 106.7 million paid out. And again, if you follow it section by section, Bank and loans in Iute Group Moldova, in Iute Group Albania, North Macedonia, Bulgaria, we see an increase versus the last quarter everywhere. So this is good. And again, this is the result of quality coming first, and when we see that quality is there, we start pushing the accelerator pedal. And maybe last but not least, if we look at the gross loan portfolio breakdown, we see that Bank gross loans exceed 100 million euro mark. We see that Iute Group Moldova went through 70 million euro mark, standing now at 72. Together in Moldova, our gross loans stand at 175 million, give or take. Albania almost made it to 100 million, also increasing. And we also see increase in Macedonia, which is now standing at 45 million. We expect to have increase also in Bulgaria. Again, quality comes first, quantity thereafter, but we are very hopeful and expectant that we start accelerating in Bulgaria as the next step in our evolution. Regarding the asset quality, I'm still very firm about CPI. I'm very keen about CPI because what matters is the cash flow and how well customers fulfill their repayment promises towards us. And as I said, CPI is improving. But if we look at the net loan portfolio quality pie, we see that in stage 1, 2, and 3 together, the total share is give or take 5%. And the share of non-performing loans through the history, if you look at dynamic value where the arrow is pointing us, we see that arrow is pointing downwards, meaning that non-performing loan share is in decline. And from gross loan portfolio, it now makes 8.5% and net loan portfolio 4.2%. Interestingly, when we give it over to you, Crystal, regarding the cost analysis, we also see that the cost of credit or credit losses equals to the non-performing loan share in the gross loan portfolio. And the impairments to the interest income stand at steady 28%. What I should point out and would like to point out is that the interest income in absolute terms is increasing. In relative terms, we are decreasing the APRs of our loans that we pay out. And if last year, at the same time, we were talking about APRs in the range of 37. So loan portfolio was yielding 37%. Then this year, during first 6 months, we talk about APR 35. And in the foreseeable future, we can predict that the average APR will decline down to 33% sometime by end of this year. Of course, this is talking about the future and markets change, the markets are dynamic. But we can expect further decline in APRs, which we more than set off with operational efficiency and increase of the loan portfolio. Well, I think I have now spoken enough, and Tarvo, you want to take it over from me?
Yes, just for this one slide of portfolio quality, you emphasized already that numbers talk a lot, they speak for themselves, and it's always nice to see good numbers, yes, supporting our success and the narrative, positive narrative. So in that sense, it's good. We are improving almost across the board, especially strong improvement comes from Macedonia. So that's things seem to be working well there for us, and a lot of work has been done behind it. But we do see some struggle with Albania. We have done some corrective measures and improvements there, so I hope to see improvement there as well. But generally speaking, both the general CPI and the recent payout CPI both are looking good. And there's an improvement in comparative terms. Other than that, nothing special to emphasize here.
Well, actually, say that despite of being very on the growth route, and despite of being digital, not even seeing all the customers, and despite of increasing the exposures with recent payouts, meaning the recent payout we measured by last 6 months.
No, the recent payout is a little bit more complicated than it's not so simple. But let's say that we take a look at the payouts second installment. So if you have a payout group, a vintage group, so to say, you take a look at each loan's second installment, whether it has been repaid or not. So that's how you measure the most recent dynamics of the quality, to see very short term how it performs.
In other words, what you are saying is that when we assess customer repayment discipline, We don't look at the first installment. Darling, it's very nice that you made the first repayment.
Good to have, but
Second
tells us whether you stick around or we made a mistake.
Okay, and essentially you say that 95.7% of the second installments have been repaid on time or with maximum 30 days delay.
As a group weighted average, yes. By country, we see separately as well how countries have been doing, and actually we are not expecting 100% from anything. So normal thing is to have around, let's say 90, 96, 97, then we are in a good shape. And you can see that in all countries, even Bulgaria is approaching that level. So I think we see good numbers.
Okay, do you want to take us further from here? Or
as I said, numbers look good so far, so nothing else to add.
Okay, then we move on to the next slide and we wait your questions. Krista, please.
Yes, thank you. So Tarmo started the call to say thank you to teams. And I would like to start and say thank you to investors, because without investors' trust, we haven't made the refinance exercise. And due to your trust, we also issued the new bond, 2030 bond, in a volume of 140 million euros. So thank you. Now regarding financial KPIs, as already said, total revenue up close to 60 million euros. Consolidated basis, revenues up by 11%, and increase comes from Iute non-bank side. Iute non-bank side revenues up by 13%. On a yearly basis, revenues at Bank side stayed pretty much the same level, increased just by 1%. But what I would like to add that first time since acquisition at the beginning of 22nd, on quarterly basis, we saw revenue increase at Bank side by 17%. We ended up first 6 months of 25 with net profit of 6.7 million euros. And the main lift for the reason, of course, higher level of revenues. At the same time, on a yearly basis, our operational costs and allowances stayed pretty much at the same level. Yes, we also received a refund from Macedonia regarding the one-time solidarity tax we already paid in year 2023, and a slight increase related to a forex gain during the 6 months of 25. And based on that, net profit margin up to 11%. OPEX to revenue ratio on consolidated basis 36.7. And later on, you can also see that on quarterly basis, we see a constant decline of OPEX to revenue ratio at Bank side. Leverage ratio is extremely high at the level of 5.9. But due to the delay of the settlement of 2030 bond, actually we were not able to start increased payout in June, and basically aggressive increase of payout we were able to start only in July. But of course, leverage ratio at the level of 5.9 is not satisfying. But as I said, it is temporarily, and definitely we will see decline of leverage ratio during 25. Capitalization ratio at the level of 24.2, and the interest coverage ratio at the level of 1.6. If we move further, Yes, regarding revenues, as you also see from the graph, that revenues at Enefbank side remained flat, and increase comes from Iute non-bank side. Still, on consolidated basis, 90% of revenues are produced by loans, followed by wallet, and then insurance revenues. But extremely happy to report that on yearly basis, insurance revenues up by 67%. And yes, once again, you can also see that on quarterly basis, revenues at Enefbank side increased by 17%. Yes, let's move further. Regarding a net interest margin, once again, consolidated basis, net interest margin up to 5.3%, mainly for reasons coming from Iute non-bank side. Despite the fact that APRs are declining and also funding is going up, we still able to increase net interest income by 5%. Net interest margin at Iute non-bank side slightly dropped to 27.1, and at Enefbank side 13.9. A risk-adjusted net interest margin at Iute non-bank side 14.3, and at Enefbank side 13.4. And as I said, on a yearly basis, allowance is slightly up. Allowances increased on a yearly basis by 9.6%, but at the same time, gross loan portfolio increased by 18%. And of course, as also regarding revenues, the same applies regarding net interest income breakdown. The biggest impact comes from Albania, then followed pretty much equally by Moldova and Macedonia, and then already Bulgaria regarding Iute non-bank side. Let's move further. And our operating expenses. As I said, we are able to see that on a yearly basis, OPEX at Enefbank side stable, no increase, and small increase of OPEX coming from Iute non-bank side. Still, the biggest portion of OPEX belongs to salary cost, and the increase of OPEX at Iute non-bank side is mostly impacted by increase of our in-house IT team. Consolidated basis during the second quarter, OPEX to revenue ratio at the level of 36.7. At Iute non-bank side, it is even 33%, and as you see, at Enefbank side, 60%. So we are seeing decline of OPEX to revenue ratio at Enefbank side. As you know that we have set the target for Enefbank to keep OPEX to revenue ratio not more than 50%. And with the increase of revenues over there, with stable OPEX over there, we definitely see a drop of OPEX to revenue ratio at Enefbank side in the future as well.
The trend continues.
Yes, exactly. Let's move further and adjusted EBITDA. As I already said, yes, consolidated basis, adjusted EBITDA increased by 18%, despite the lowering APRs. And as you see from the right hand, that the biggest impact to EBITDA comes from increase of revenues. Just a slight increase of allowances and slight increase of operational cost. That is basically the reasons adjusted EBITDA increase on a yearly basis by 18%. And let's move to the last slide. Yes, as Tarmo already said, we ended up with assets in a volume of 462 million euros. Equity at the level of 77 million. And we also had extremely high level of cash because of the delay of the settlement of new bond. But still, 85% of assets belongs to cash and net loan portfolio. At the end of 6 months 25, we had interest-bearing liabilities in a volume of 372 million euros. Most of it belongs to bonds, followed by loans and deposits, and then 15% belongs to B2B platform. Interest coverage ratio at the level of 1.6. To sum it up, yes, as I already said at the beginning, we had a strong first half of 25, even stronger second quarter of 26. We managed refinance exercise, we issued new bond, and first time since acquisition, we are able to see improvement at Elmbank side. With that positive note, floor is yours once again, Tarmo.
Thank you very much, Kristel. You have carried out very well, and there is a lot going on in the group. So to keep discipline in the execution is very important, and also to remain steady and not to change the course. So we are seeing the results, and that's why we are so proud to sit today in front of you with these numbers. I think that this concludes our unilateral flow of information towards you, and now it's time to take the questions. If you, Judith, will take over from us now.
Yes, thank you very much for the dive into your numbers, and congratulations to your growing success. Ladies and gentlemen, it is your turn now as we move on to the Q&A session. For a dynamic conversation, we kindly ask you to ask questions in person via audio line. To do so, please click on the raise your hand button. If you are dialed in by phone, you can use the key combination *9 followed by *6. And if you do not have the opportunity to speak freely today, you can also place your questions in our chat box, as one person already did. And I will start with that. You mentioned the 5.9 times leverage ratio is temporarily high. Could you give some indications of your targeted debt level by the end of 2025?
Yes, as I said, it is definitely a temporary situation because we were not able to start using the fresh money immediately. And as you all see, revenues at the non-bank side are increasing due to the, of course, higher level of loan book. So we are expecting the same trend in the future, and based on that, our aim is to have leverage ratio at the end of 25, not more than 5.5.
Thank you very much. And we have one question left. Dear attendees, the stage is yours now. This is your place to place your questions. And the question is, how big of a role does competition play in lower APRs versus the shift to longer maturity, higher loan tickets? Do the competitors show better customer engagement on their bank and non-bank apps?
Competition certainly plays a role, and the competition we see coming from the banks, from the established banks. I see that there are two runs happening at the same time. Iute Group running towards becoming fully digital bank on the one hand, and on the other hand, the legacy banks, traditional banks, trying to run towards becoming fintech banks and making their services available digitally, starting from the onboarding. Just the fact of gaining a customer without having the need to invite the customer over to the bank branch. So I think that is going on a competition to the so-called middle of the floor. And that competition also applies to the lending, where on the one hand, Iute loans tend to be on the more expensive side of the consumer finance as compared to the banks. But we are making our effort as regards customers' comfort, convenience, and the speed. And on the other hand, banks who can rely on the more cheaper sources of funding and also established big customer bases. Certainly, banks are our competitors, and in order to beat them, we also have to beat them in their own game as regards the speed and convenience. We do it, but we have to beat them also in terms of pricing. And the customer experience is a whole. It's not only race to the bottom as regards the price, but it's a whole which consists of the speed, convenience, and the price.
Thank you very much. And you may have been very clear and transparent. That is why we don't have any questions yet. I will hold the room for another moment if someone wants to raise their hand, as there is one person. You should be able to speak now, Fall.
Yes, good morning. It's Frank here from Berlin. How is everybody in Tallinn? Thank you for the presentation. My observation, Tarmo, is net interest margins keep falling for quite some quarters. And on the other hand, you now have looked in your refinancing costs with a new bond. So everything kind of looks a little bit like you really need to work on OPEX and bring in growth, and that's what's generating the growing profit. Is that right? Approximately the right description on a very high aggregated level?
I would add only one thing.
Please.
The Eurobond makes less than half of the group's total liabilities. So it's important to point out this fact. The outstanding 140 million is less than half.
Right.
So, but the general trend, you are correct that the net interest margin corridor becomes narrower and narrower. So it's a question about volumes, it's a question about OPEX to revenue ratio, and it's a question about credit quality.
Yeah, credit quality, I just assume you keep that approximately in balance. Now, has there ever been or will there ever been a opportunity to utilize the deposits in the bank for functioning as a refinancing tool for the rest of the group? You could repackage some of the loans, let's say, in one country and maybe sell them to the bank or do different things like your competitors in the market who we also speak to seem to have found small niches how they utilize bank financing for the rest of the group. What's your thinking here? Or is this really the cash in the bank is really for lending by the bank, period?
Short answer is no, the shortest possible. And if I elaborate, the bank's assets and liabilities are segregated from the non-bank financing business. This is principle number one. Principle number two, bank follows its own credit risk policy. And the objective is to make the bank participate in the digital lending market on its own as a market actor. So as to increase the bank's own loan portfolio, which can be built by acquiring fully digital customers with fully digitalized loans. So that's the journey that we are following. Now, having said that, we also have to take into account that the markets where we operate are also segregated on their own. They are isolated. So Moldova is a market on its own with its own national regulator and not very developed cross-border market practices. And so the same applies to Albania. The same applies to North Macedonia. The only country which is really part of larger capital market is Bulgaria. They are member of European Union.
And coming back to the growth assumption, you do feel that you have the markets where you can grow, where you have the growth potential looking forward the next few years. You don't need to add another market or do anything else we haven't talked yet about. You're happy for regional markets, and that's where you're active.
Oh, we certainly are aspiring to grow into some new markets, and we are hopeful that it will come. But having said that, the growth into or expansion into a new market is not exclusive to the growth in the existing markets, and we haven't touched the ceiling. We see great potential. We see great synergies between the value streams of insurance, wallet, and loans. And we haven't actually really tapped it. We are just about to start now.
And around the wallet, do you see other function you could add, like FX, like I don't know. You do the insurance, you do the lending, you do anything else that could be attractive? Congratulations, by the way. Cooperation with Allianz, of course, is #1 insurance company in the world.
Yes, those strategic partnerships are very, very important. And as I said, our existing markets, I mean, now we go a bit into philosophical mode, but I think at any given moment, at any given market, there is an opportunity, at least in modern era where, the technologies and the product change every 3 to 5 years. When did you start using Spotify? When did you make your first e-com purchase, etc.? Think back. It was not that long time ago. So there is opportunity in every market. And the question is whether you decide to ignore it or sleep next to the opportunity or to move. We are certainly on the move, and numbers will prove it. And I refer to the number of active customers. If we show growth, it means that we have tapped something.
Right. Thank you very much for that, and wishing you a good second half 2025, and a happy morning. Bye-bye.
Your money is safe, Frank. Thank you.
Thank you for your questions, Frank. And we have one more question in our chat box. From which country did the 1.7 million FX gain in the second half of 2025 come from? Any comments on what are your total expectations for FX impacts in 2025?
Regarding the forex gain, it is not coming from one country, but split it between Albania and Moldova. Higher level comes from Albania during the last 6 months of 2025. What is the expectation regarding 2025? I hope that basically the same trend remains as has been during the first 6 months. So I really hope that we will not see big fluctuations in Albania or Moldova. So in that regard, I believe that yes, forex gain, let's say in range of 2 or 3 million for whole 25 is the basically realistic view.
Thank you very much. And in the meantime, we have received no further questions. Ladies and gentlemen, this is your room now, and I will hold it for another moment if there should be any questions left. And that doesn't seem to be the situation. We therefore come to the end of today's earnings call. Thank you for your interest in Iute Group AS. Should further questions arise at a later time, please feel free to contact Investor Relations. A big thank you also to you, Tarmo, Crystal, and Tavo, for your presentation and the time you took to answer the questions. It was a pleasure to be your host today. I wish you all a lovely remaining week, successful business. And with this, I hand over again to Tarmo for some final remarks.
Well, we have to thank also our customers for the results. I hope that they are as grateful and happy as we are with our results, that they are happy with the products and services we have delivered them. So we look forward to the growth in customer pool, and we also look forward to achieve the annual targets which we have communicated to the investors, and we are firmly on track. So thank you very much, everybody, and we talk again when we are presenting our Q3 results. Goodbye.
Thank you. Bye.
Bye.